Hello, this is SeeWing Yee from the Yee Real Estate Network. I am a real estate financial advisor, wealth builder, if you will, and we have helped many out-of-state remote turnkey mom and pop investors to buy in different markets in the US, positive cash flow properties, the fastest growing markets in the country. And we have teams available. We have a one-stop shop system available at each market that we represent on behalf of our investors. All right, so without further ado, I am merely going to talk about the following on this particular podcast, and I will share my screen. I'm going to talk about tax benefits associated with real estate investing. So with that in mind, I'm going to share the screen, and here we are. I just want to take a step back and look at the big picture. The big picture is once you buy an investment property at a good location for the long-term buy and hold, you income property, specifically single-family home residential investing, that should be your primary focus. Although secondarily, we do like some good duplex and triplex and fourplex in a good markets as well. We'll talk about that at some other time. So this is our core philosophy. So single family home income property, for the lack of a better term, is an ideal investment. Is the history's most proven, most powerful, most attractive, multi-dimensional asset class. Why? Because ideal, the word ideal means of the following. I means income, D means depreciation, E means equity growth, A means appreciation, and L means leverage. Now, if you click on my YouTube channel, I'm sure you can scroll down and find some other topics that we can discuss in detail on some of these acronyms. But today, for a few minutes, we're only going to talk about the tax benefits, the D component, the depreciation component of it, because I'll touch on the I means income, income means cash flow, right? Find the right property, find the right market, surround yourself with a team that can help you produce cash flow income properties at typically 20 to 25% down payment. That is the strategy involved, right? Equity growth, right? You hold the property. E means equity growth, you hold the property for long-term appreciation, or buy at a very long-term buy and hold, right? This is not a get rich quick scheme. No. Appreciation, A stands for appreciation, same thing. Leverage, right? You use other people's money, OPM. You get the leverage of a loan, tremendous fixed rate 30-year loan at a historical low interest rate. So with that said, again, I just want to give you another reminder of the multi-dimensional aspects of buying a rental property. So now I'm going to talk about tax benefit, as I indicated. So, and let me go through the appropriate section. Okay, this is section. This information right here is very critical, right? At a high level, I mean, an investor, you have three components of earning money. Your earning income, right, which is your W-2 income, your 9-to-5 job, right? That rat race that you are trying to pursue. So yeah, yes, the dreaded rat race. You work hard for your money. However, and a lot of people think about it, right? History tells you that real estate is the best means of creating wealth. That's a given. Having said that, you cannot achieve total financial freedom using only your job income, your earned income, right? Because as indicated here, you're being taxed at the highest level, federal and state and other kind of taxes that eat away your income. So most earned income, your paycheck every single month, right? You have more month at the end or the money, like they say, right? So relying on earned income strictly will not, for most people, allow you to achieve total retirement freedom. Now, some of you are decent savers, investors. You might want to venture into portfolio income. We're talking the stock market, right? Mutual funds, IRAs, which is fine, but it's very, very hard using your earned income, your paycheck, to allocate certain percentage of your money for stock market mutual fund investing. So it requires a substantial amount of money to put into your portfolio income through the stock market and mutual funds to achieve the interest income, dividend income, and capital gain you need to sustain your future retirement, right? You cannot rely on the stock market alone. And finally, in my opinion, of course, passive income is the best source of investing. Passive income, really, the word passive means like you don't have to work hard. You work smart for your money. You let your real estate money work hard for you, especially when you use the turnkey remote investing approach, whereby that's something that we practice, right, in our organization, the Yee Real Estate Network. And you just buy property remotely. I have the team on the ground to vet everything for you, find the right property, find the right market, find the right cash flow properties, and get the property management to manage your property. So that's you have the ability over the years that we have helped many investors. You have the ability to buy 3, 10, 15, 20 investment properties, and really you don't need to spend more than a few hours per month managing your property, if at all, right? Because you're not really working hard, because the property manager is doing most of the work for you, right? So you're really investing passively, you're investing remotely, very little time that you need to allocate from your time to allow you to achieve retirement. It's important time once you accumulate a sufficient source of income by buying multiple rental properties spread across different markets to allow for real estate diversification and asset allocation. Does it make sense? Hopefully it does. So the word passive, have a good ring to it, right? I mean, you're not working hard, you're working smart, and just get your mailbox money, get your cash flow and your rental income coming in to sustain, to help with your retirement, whatever that definition is for you, right? So, yep, so income properties, investment property, in particular, single family home residential investing, maybe sprinkle some duplex, triplex, and fourplex here and there to efficiently create your so-called real estate portfolio. So passive income is the way to go. And then, so let me go over some specifics of the tax benefit, okay? I mean, by the way, I'm not a tax advisor. We are not giving tax advice. Everybody's situation is different. You need to consult your own tax advisor to go over your unique situation. Does it make sense? Right, this is just an educational kind of deal. So I'm not gonna spend too much time on it. I'm gonna share with you the high level. The high level, what I'm trying to say is, for the remaining few minutes, we are going to talk about passive losses, all right? So passive losses means that, again, once you file your tax return, if your adjusted gross income, whether you're single or married filing jointly, is $100,000 or less, if you have some, you can get depreciation, right? So depreciation basically allow you to have a paper write-off against your earned income. So, in fact, I might want to. All right. Anyway, if your adjusted gross income is $100,000 or less, you may, on paper, deduct up to $25,000 of your paper depreciation loss, your passive loss against your earned income. All right. So now here's the catch: if you earn more than $100,000 per year, and the less than 150,000, somewhere in that range. So the law phases out any loss deduction at 50 cents on the dollar for each dollar over 100 grand. I know that's not that easy to explain, but so typically if you own, now let me go back a little bit. Each property you own, here we go. How to calculate depreciation, right? So let's say you buy a single family home for 270,000 as indicated here, right? The land component of your property typically are not depreciable. So the land, let's say the land is 20% of the building, of the structure, right? So we deduct the land component, which is not depreciable, at 20% multiplied by 270,000, which is 54,000. So $216,000 of it is how you calculate your depreciation on this one property that you purchased for 270,000. Let's assume it's a single family home. So the IRS law allow you to divide this depreciation basis over 27 and a half years for 1 to 4 units. Okay, anything over 4 units is a commercial building, and I believe the depreciation method is around 39 years for commercial properties, which is you get less benefit over 39 years than 27 and a half years. So in this case, $216,000 divided by 27 and a half years equals $7,854. What does this mean? This means on this one property alone, at the end of the year when you file your tax return, this $7,800, $54, if you make less than 100 grand, this money will offset against your working income. So if you're at a tax bracket of, let's say, for the sake of discussion, at 30% federal tax bracket, just do the math. 30% multiplied by 7,854. So you could achieve several, more than $2,000 of net benefit against your taxable income. I mean, you understand? So just on just one property, you can achieve very, very significant depreciation, paper loss. All right, so that's how it goes. Something on another video, we can talk about cost segregation. There's some further detail tax benefit above and beyond depreciation. You can do some accelerated depreciation, use cost segregation. That's that's another topic that we discuss some other time. All right, so I'm gonna finish up. So again, I know many of our investors located in the Bay Area, I mean, your income is typically more than 100 grand, but you may not get the full depreciation, passive losses depreciation under normal circumstances. But again, if you make less than 100 grand per year, you can deduct up to 25,000 of depreciation / passive losses against your earned income. Very, very, very significant. So if you make between 100 and 150,000, you get a phase out deduction at 50 cents to a dollar for each $1 you make over 100 grand. To a point where if you make more than $150,000 per year, you would not get any kind of depreciation. Any kind of depreciation you're able to obtain on that particular tax year will be suspended indefinitely toward the future years, right? So if each year you make more than 150 grand, all the depreciation, passive losses that you're unable to will carry forward in the future years. That future passive losses benefit may be applicable when and if you were to sell the applicable rental properties in the future. When you sell the property, normally you have to pay taxes, but you can offset the taxes by when you sell the property and you make less than 150 grand, right? You can use quite a big chunk of your passive losses to offset against your capital gains. Okay, or then you can do a 1031 tax deferred exchange. But I'm not going to talk about that. It'll take so much more time. But this is a short video. That's all I want to cover for right now. Now, one more thing. I keep saying that, but if you make more than 150,000 and you're unable to deduct any current passive losses, depreciation on a current tax year, right? You can become a real estate professional, which is a very highly complicated rule. Again, consult your tax advisor. I'll give you one final explanation what this means as a real estate professional. If you own a lot of rental properties, 5, 10 rental properties, and you exceeded the $25,000 passive loss threshold, and you exceed more than 150 grand, but you cannot get any deductions. If you, as a single person, or marry a quote unquote real estate professional, you can get unlimited passive losses to offset against your high income on that particular year, regardless of your income level. But this is a very hard rule. It would require a lot of time to discuss. But having said that, let me give you one quick bonus before we end this presentation. To become a real estate professional, one of you, if you marry filing jointly, one of the spouse ideally does not work, or maybe work part-time, because the non-working spouse can become a real estate professional as long as he or she that manages documents 750 hours of a material participation hours, 750 hours per year, which is 15 hours per week. If that's the case, if the working spouse making huge amount of money, making like $200,000, $300,000 per year, you have, and the non-working spouse can document, follow the rules, become a real estate professional, if you will. You don't need a real estate license to do that, but require a lot of documentation. You have to, if you have a lot of passive losses, that'll be ideal, right? If your working spouse make, or in the top federal tax bracket of maybe around 39%, and you own 6 or 7 rental properties, and you have like, that triggers depreciation passive losses like $60,000, $70,000, $80,000 on your portfolio. That $60,000, $70,000, $80,000 or more of passive losses can offset dollar for dollar against the working spouse high working income, therefore drastically reduces your tax you have to pay. All right, so that's all I want to cover. I don't want to go into too deep because I'm not giving you tax advice. Consult your tax advisor, but just to give you some, sampling of how much benefits you may have by owning an income property. All right, so that's all I have to say. Thank you so much. Sorry, I cannot give you in-depth analysis of it. Required a lot of hours to explain. So you need to continue to educate yourself. So you buy properties, surround yourself with a good financial team, tax accountant, attorney, real estate advisor, mentor, coaching, consultant. Surround yourself with a team that will help you to do all those advanced tax strategies. Okay, thank you so much. This is SeeWing Yee from the Yee Real Estate Network. Hopefully you receive good value from this short presentation, and I will see you in the future to talk about some other real estate topics. Thank you so much. Have a nice day. Bye-bye.